For every trading setup that we take, there is a possibility that our stop loss order is hit. And for every setup that we are stopped out of, there is a possibility of re-entering the position. Re-entering after a losing position is an important concept that will differentiate the better traders from the average ones. If you know when and if it's really the time to re-enter, you will improve your trading results by a vast margin. So today we'll discuss the pros and the cons of re-entries and the best setups that qualify for a re-entry. When you are stopped out of a trade, there are two possible scenarios. The first scenario is that your market analysis was wrong. The market has changed its bias, or the market momentum has turned against you, and your trading strategy failed to detect it. In such cases, as long as you are consistent in your analysis and have not broken any trading rules, you should accept the failure of the trading setup with grace. You move on and wait for the next trading setup. The other scenario is that your market analysis was right, but your timing was wrong. It means that despite being stopped out of your trade, it remains likely that your anticipated market direction is correct. In that case, you should try to re-enter the position in order to capitalize on your market analysis. It sounds easy and logical, but there is the obvious question: how do you know which scenario you are caught up in? If you are caught up in the first scenario, but you persist in thinking that your market analysis was right, you will end up by multiplying your losses as the re-entry gets stopped out as well. This is not uncommon because when traders get stopped out of their positions, they often imagine that they are facing the second scenario, so they have an excuse to jump right into the market again for more action. Such behavior leads to consecutive losses, and for many traders, that is all it takes for them to engage in self-destructive behavior like revenge trading. If you are facing the second scenario and yet you abstain from re-entering the market, you are losing out on a solid trading opportunity despite having the correct market analysis. And it's the emotional consequence that will affect you. You are right, but you somehow lost money. It is difficult to accept that you are wrong and therefore you lost money, but it's even more difficult to accept that you were right and yet you lost money. Instinctively, you want to get back into a live trade. This mentality is again self-destructive and will almost certainly cause over-trading. Re-entries offer a second chance to enter the market and overcome timing errors. However, it's a dangerous technique with important implications on your psychology. That's why it's crucial to have clear guidelines to distinguish between the two scenarios and adopt the right course of action. These guidelines provide a rational bias for determining if you should re-enter. Of course, they are not perfect. You might still end up confusing the two scenarios. However, with a set of guidelines, you are less likely to lapse into the kind of self-destructive behavior we've talked before. Now let's address the re-entry criteria. Here's the most important rule. Before you re-enter the market, you must make sure that the market bias is intact. If the setup failure has caused you to doubt your original assessment of the market bias, then you should not re-enter. Do not jump back into the market simply because you cannot accept you made a loss. Beyond the quality of the setup, there are two main reasons why you should not re-enter. The first reason is that the setup has failed and is no longer worthy of a re-entry. So let's take an example of a failed short setup that denies a re-entry attempt. We have a downtrend with a bearish pressure indicated by these wicks. As an entry, we waited for a strong bearish bar that could act as our setup bar. The strong bearish bar occurred here, and we shorted below its low. However, the market rose and hit our stop loss order placed above the high of the setup bar, so the previous bearish pressure zone was no longer valid. The bar hitting our stop loss was also a strong bullish bar. In this case, we should not re-enter the short setup because our initial scenario is no longer valid. The second reason why you should not re-enter is related to your target. At times, you will get stopped out of a successful trade because your target is too far away. In such instances, it's not a case of unrealized potential due to timing issues. The trade potential has already been realized by the market, but you did not realize the profit. Remember this, re-entries are meant for fixing the problem of good trades being stopped out before they become successful. When a trade is already successful, there is no basis for a re-entry. Here's an example of a partially successful long setup that got stopped out eventually. We have a pin bar in an uptrend, and our entry occurred as the price broke the high of the setup bar and continued higher. Eventually, the market fell and hit the stop loss order. However, as mentioned, you should refrain from re-entering the market because there were no timing problems and the original setup was invalidated. Now here are my own rules for a long setup re-entry. First, the bullish market bias must be intact. Second, the original setup must be a high quality one, occurring at an important level in the market, support or resistance. And third, price must not close above the high of the initial setup bar. So if the initial setup bar was a pin bar and the high of the candle represented my entry, but the price didn't consolidate above the high and didn't break the level convincingly, I will consider re-entering if the market presents another opportunity to go long. Let's take an example to make it crystal clear. The market found support in an uptrend, and we identified bullish pressure after analyzing the wicks of these bars. This combination presented a high quality setup for a price action entry. The setup bar was a strong bullish bar, and we entered above the high of this bar, placing our stop loss below the low of the setup bar. Price fell and hit our stop loss order, but found clear support as shown by the long lower shadow of this pin bar. Note that the market hit the stop loss order, but didn't close below it. Furthermore, the bullish bias was still intact, hence we could re-enter the setup after another bullish bar. All three rules were met for the re-entry. The signal occurred at an important level of support, the bias remained bullish, and we didn't have convincing price action above our setup bar. For a short re-entry setup, the bearish market bias must be intact. As in the case of a long re-entry setup, the original setup must be a high quality one, occurring at an important level in the market support or resistance, and price must not close below the low of the initial setup bar. So if my initial setup bar was a pin bar and the low of the candle represented my entry, but the price didn't consolidate below this low and didn't break the level convincingly, I will consider re-entering if the market presents another opportunity to go short. Here the market broke a bull trend line with momentum, confirming the bearish bias. Then, price found resistance around this area, offering a high quality short setup. We shorted after this bearish bar, with a stop loss above it. The setup bar was followed by a bullish bar that hit our stop loss order. However, the bar had no bullish follow through. We then have multiple wicks showing bearish pressure, offering us a chance to re-enter the short trade. Again, all three rules were met for the short re-entry. The signal occurred at an important level of resistance. After a trendline breakout, the bias remained bearish, and we didn't have convincing price action, meaning the price didn't close below our entry point. A useful way to identify good re-entry setups is to watch the speed at which your stop loss level rejects the market. If the market hits the stop loss of a long setup and rebounds quickly upwards, it might be a good re-entry opportunity. The same for a short re-entry setup. In addition, to avoid the risk of using re-entries as an excuse for overtrading, you should only re-enter once. When you are stopped out of the original setup and the market presents another opportunity, you re-enter. But if your re-entry trade is stopped out, stand aside and re-evaluate the market. Remember that when you are stopped out of a trade, it might be a timing issue or a market bias issue. Re-entries can fix the timing issue, but not the market bias issue. With each trade you are stopped out of, the probability that you are not facing a timing problem increases. If the problem lies with having a wrong market bias, then re-entering the market will only cause more losses. This is why you must limit the number of re-entries. In fact, very often after the first re-entry is stopped out, there are already signs of market consolidation, which should prevent further re-entries. Although I tried to add my own rules, this is not a mechanical process. This is a discretionary approach to trading that focuses on prudence and patience. So always consider the market bias before considering a re-entry. With time and experience, you'll learn when to re-enter and when to abandon the setup. Remember that it's a big difference between re-entering a trade because it's still a valid opportunity and re-entering a trade because you want revenge for a loss. Make sure the opportunity is valid and don't let the recent loss affect your judgment. As always, if you learned something new and found value, leave us a like to show your support, subscribe to our channel and click the bell icon to stay in touch when we upload new videos. Until next time.